Hello traders, Gary Wagner here. Just about 11:20 in Honolulu, 4:20 in New York. It is Tuesday, March the 7th, 2017, and this is the Daily Report for Gold and Silver. We have continued downside pressure in the precious metals as the market sentiment about an interest rate hike continues to grow. Gold currently trading off about $10 on the day, trading at $12.1570, putting it down $9.80 to be exact. The low on the day is $12.1410. And the high, $12.2740. Of course, we have a current long position with stops in place below $12.16. And I sent out a special trade alert this morning talking about two distinct strategies, a conservative and an aggressive strategy to work with this current pricing. Of course, we will discuss that in detail as we pull up our first chart. But for right now, we do have the market kind of settling down after a dramatic sell-off today, this being the sixth consecutive day in a row in which gold prices are lower. Today, taking it off about 0.8%. Silver traded even lower today in terms of a percentage drawdown. Now that's off about 26 cents, trading at 17.51. The low 17.49 and the high 17.82, but the net change is almost a full 1.5% drawdown on the day. Of course, we have been neutral in silver and we have been long in gold. Let's take a look at our first gold chart so I can talk to you in detail about the strategies that I sent out and which one I favor and why. So traders, as you know, this morning, right before I actually began to film the show, I did send out a special trade alert as we were getting very, very close to our stop being hit. We still are very close to our stop being hit. Market currently trading at $12.1580. Our stop was put under $12.16. I'm calling it effectively just under $12.13. And the trade alert that I sent out offered two different strategies. The first strategy is obviously let the trade run as it will, and if it stops us out, it will stop us out. If it does not, in other words, if the stop actually holds where it is, we can look at a later point after a defined bounce to actually add to that position, and that would be under the likelihood or the remoteness that the stop wouldn't get hit. We're very, very close, currently trading, as I said, right around $12.16. The second strategy, of course, is a much more aggressive strategy, and it's a strategy that I favor, and that was to add to the position as the market was under pressure and put all stops below, I believe I said 1207. Now, here's the rationale behind that. The market itself has been under pressure. I absolutely think that it is overdone as it factors in a potential interest rate hike, which in all probability will occur next week. Of course, at the end of this week, we have the jobs report coming out. Early estimates are at around 190,000 new jobs added in February, which would be enough to warrant a rate hike based upon statements that have been made by the Fed. Now, on a technical basis, and this is where I felt the aggressive play has some merit, I've run two basic Fibonacci retracements. The first one is a long retracement starting at 1124 and going up to the top of the market at 1264. You can see those are our hash marks right here on the far left. 50% retracement, 38, as well as 23. And I draw your attention, of course, to the 38% retracement because our second fib retracement, which is a much shorter sequence, begins here. I believe it's 27th of January. Market is trading at a low of about 1180. It trades up to, we take it up to the same high. And when we do that, we get a 61% retracement of 1211. Now, the reason that that seems to hold some weight to me is, first of all, we are basically looking at the actual market move. This last real rally, which is the shorter of these two rallies, or I should say the second leg, this being one of the first legs, a correction, and then this being the second leg, this correction right in here was really a compression triangle. But that being said, 61% is a logical point to look for a correction from this second leg. At the same time, the fact that you have a Fibonacci harmonics, and I define harmonics different than many other technicians, because to me our harmonics is when you get two different sequences, meaning we're starting at a different price point and at a different time, and they conclude or have the same number come out, only being a different fib number, but both important numbers. And of course, a 38% retracement as well as a 61.8% retracements are critically important. The fact that they line up together and you get that harmonics tells me that at least on a technical basis, there is a strong possibility that we will see some support come in the market. We're certainly going to see it come in the market anywhere between 1212 and at the lowest maybe 1200 or 1195, and I don't think it's going to go that low. But you know what? I thought that 1221 would hold, and in fact it didn't. So for clients that have taken the aggressive call, you should have your first position. You should now have your second position somewhere around 1214. All stops are going to be under this low here, and that's where the 1207 comes in at. I'm trying to put it under these most recent lows and give it a little bit of room between this level here, which is the 1211, 1212 area, and the possibility that it takes out a lower low before finding support here. But maintain your current long position, maintain your add. All stops should be at 1207. For conservative traders, maintain your stop just below 1213. If in fact the market does recover and we see a bounce where we're not stopped out in that circumstance, I will directly recommend the point in which you'll add to that position. But for the conservative trader, I'm going to need to see a pretty decent bounce. Traders in other markets that we do follow, we do have continued pressure now also in the U.S. equities markets. Dow Jones Industrial Average closing off by about 1.5%, less than 0.2% in terms of the net change, down about 30 points at 20,924. This being the third consecutive day of lower pricing with very, very small changes, a doji candle, and then the fourth day in which we have seen this market trade lower. S&P's also trading lower, off about 0.33%, as you can see, 2368. And then when we look, of course, at NASDAQ is also going to be off about 0.33%, currently at 58.33. Now, of real interest to us is the dollar. Dollar is trading higher and contributed slightly to today's decline in gold, but it was a slight add-on, so to speak. Think of it this way. Gold closed off by about 0.8%, with 0.15% of that drawdown attributable to a strong dollar, which means the remaining 0.6% is directly due to selling in the market. So traders, as we talked about when we looked at gold dropping, obviously the dollar has got an influence on gold because we pair it, the dollar with gold when we trade it. Now, dollar's up 0.16% at 101.80. Gold is trading down approximately 0.8%. So the differential, or about 0.6%, is due directly to normal trading, whereas this remainder, the 0.16%, is due to a stronger U.S. dollar. The dollar has been relentless, and the thing is that we are factoring in the potential for an interest rate hike, which would, of course, initiate on the 14th and be announced on the 15th. There's a high probability that that will occur. They've come out and done everything but painted it on walls and graphs and bus stops and train stations, so to speak. They have been transparent. I'm speaking about the Fed, of course, and they are giving us as much warning and information as they can to let us know that there will be an interest rate hike, that the variables that they look at say that it is appropriate. Now, based upon that statement and the fact that interest rates will go higher, which of course, except for the financials and the banks, is not a bullish factor for businesses, we have seen U.S. equities trade lower over the last couple of days. We had this pretty large sell-off, this of course being Tuesday, so this being last week, of course. The market is sold off, but look at these dojis, the very, very tight-bodied candles where they open and close roughly at the same place. Also, traders, if you recall, I have been on record as stating that this gap In other words, this price void that exists will definitely probably come in and get filled. If that's the case, this market's headed to just above 20,800 because it would completely fill this gap, or as I said, the difference between this particular price void here. Traders, absolutely no doubt, we have seen more pressure than I had originally perceived in gold. Gold prices carrying much further down than we had anticipated. The stop that we put in the market has been really flirted with today as we came very, very close. As I said, anything effectively below 12.13 would knock us out of that stop, and that's strategy one, just to let that stop play out. Strategy two, the aggressive strategy, I believe has the best potential, although we are increasing the risk and potential loss if we're incorrect. If we do catch a bottom and the market moves higher, it allows us to effectively cost average and to really make lemonade out of a lemon, so to speak. The other thing that I think is critically important, as we talked about when we pulled up our first chart, is the fact that we have a strong Fibonacci harmonics at 12.11, a 61% retracement, as well as a 38% retracement based upon the two different sequences that we looked at when we pulled up that chart during the first part of the show. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow for another daily update and review. Bye-bye.